Hey everybody, this is Ryan Mallory with Share Planner's YouTube channel, and last week I talked about some of my winning trades from this year, some of the more successful trades. One of them was in Roku, the other was in Alibaba. Definitely check out the video and see what I did to make some really sizable gains in those two trades. But I had somebody leave a comment that said, hey, what about the losing trades? And I thought to myself, that's true. It's like I'm not really talking about my losing trades here. And I actually think that with the losing trades, there's far more to gain from your losing trades and experience with those losing trades than there are from winning trades, because you really find out about some of your negative tendencies and bad habits when it comes to the stock market. So when you zero in on some of those losing trades, you can really see what are you doing that can keep you from success in the stock market overall. So today I'm going to talk about two of my losing trades. One of them's in Apple, and this was not a fun trade. And the other one is in Citigroup. So AAPL is the stock symbol for Apple, and C is the stock symbol for Citigroup. So first off, I'm going to talk about Apple. And just by looking at this chart, some of you guys may already realize what's getting ready to happen here with the chart. But you can ignore these yellow lines. These are just my own drawings that I do all throughout the course of a year in a stock. But right here, I want you to focus in on that price action from January 2nd. And on January 2nd, we had a nice little rally off the lows with Apple. And I got long. I got long on January 2nd at $156.66, and that fill with the last three numbers being 6 should have probably been a ominous warning. Not really, because I don't really pay attention to that stuff. But anyways, just kind of ironic, because this ended up being like probably my worst trade in terms of loss that I've made in the swing trading splash zone in the history of it. And I've been doing this like since the Share Planner Splash Zone. I've been doing this all the way since 2011, and the website itself has been around since 2007. So any case, setting up good. I actually finished the day with a profit, and I thought, okay, we're setting up pretty good going into tomorrow. Well, that night I got a text from my brother, and he's like, man, I hope you aren't still in Apple still, because they just got shellacked. I'm like, oh man, what the heck happened? And I looked, and there was our earnings forecast warning, and it sent the stock, definitely lower, and I was pretty bummed out about that. But yeah, we saw a huge sell-off there. And when I say we, I mean I. And I sold out right in the beginning of the day. But look, my stop loss was below the 1227 low, so it was around 149 and change. Okay, that's obviously not going to happen, because we're opening up at $143.93. So my stop loss is not really valid at this point. So what do? Do you hope that it gets back up to the stop loss? No. And something like this is a sizable loss here. It could keep going lower and lower and lower, and then all of a sudden a manageable loss becomes a much bigger loss. And so you don't want that. You don't want that at all. So I went ahead, I cashed out right at the open at $144.47, took a 7.78% loss, and I moved on from the trade. You have to, okay? Now, I know it's probably going through some of your minds saying, hey, but if you would have held, man, if you would have just held past that first day, it just went straight up from there. That's true, okay? But guess what? There's a lot of stocks that don't do that. They get mired in that kind of stuff. Look at Facebook, okay? I'll use them as an example. You go back to Facebook's price action following their earnings. Yeah, they bounced a little bit, but look what they've done, from like August through January. And you look at where it's at now, it's still not where it was back at its all-time highs. So it does prove quite important to follow your stop losses regardless, because for everyone like Apple that just comes marching right back up, and I had a suspicion that it probably would, but being disciplined in my trading approach was far more important than hoping that it was going to come back up. Because here's the thing, I can allocate the money to another trade and make money again in the future. And I don't have a problem with finding winning trades, okay? That's not the issue. The problem is that if I let a losing trade become an even bigger loser, then all of a sudden I'm letting a trade define my year or my month or my entire portfolio permanently. And that's the worst thing you can do. I mean, that's why I say don't double down on stocks. Don't go trading into earnings, because these are things and decisions that you're doing that can really define your year in a very negative way. Sure, you might get away with it, okay? But that doesn't mean you're always going to get away with it. And if you get away with it once, you're going to try to get away with it twice. And if you get away with it twice, you're going to keep on trying to do it, thinking that somehow you got a nice little lottery ticket here in the stock market that's going to keep making you money, but ultimately it ends in disaster. So you have to you have to follow these stop losses. You don't want to be a person who picks and chooses which stop losses they're going to follow, because in the end, that's going to really wreak destruction on your portfolio. So Apple, I took the stop loss, I got out. Never doubted for a second that that wasn't the right thing to do. I followed my trade, I followed my trading plan. If you're getting into these trades and you don't know exactly where you're going to get out at, if the trade goes against you, you're already messing up before you even pull the trigger. So let's go ahead and look at our second one, okay? Apple, I actually think I managed that trade pretty well. The outcome, was it what I wanted to? I give it an F, but in terms of trade management, I give it an A+. All right, let's get into Citigroup. I got into this one on February 25th, and I got into it at 65.29. I held it for a while, and I really didn't do anything on it. I did not make any money on it, actually. But yeah, so February 25th, got in. This thing was actually breaking out early on in the day, even though the daily candle doesn't show it. You can see the shadows on the upper side to show you that at one point it was breaking out. I got into that, and it closed lower from where I got in at. This trade was just such an irritation from the very start. But I'm gonna fast forward to it because I held this until March 4th, okay? And eventually I got stopped out, okay? I got stopped out right there. And here's the thing. This stock just was not cooperating. I ended up tightening my stop loss to where if it broke below this consolidation pattern that had formed during the duration of my trade at that point, that I would go ahead and get out. I had a break lower at that point, and I did. So what did the stock do? It's done nothing. It hasn't done anything. And so if I had stayed into that for the whole month of March to this point, I'd be in a stock that hadn't gone anywhere for me. I got it at 63.50. It's trading at 62.24. So it's trading about 2% lower than even where I got out at. And it just hasn't done anything. And so the lesson here is to stop losses. They prevent you from getting hung up in a trade that simply doesn't want to go anywhere, that doesn't want to make a move, that just wants to trade in sideways consolidation. Because what's happening there is, one, you're increasing, the longer you stay in a trade, the more chances of something bad happening to you in that trade that creates a lot of problems for you from a portfolio standpoint. And if the stock is not rewarding you by going up, then why do you want to be into it? Why do you want to take on that risk if the stock's not rewarding you the profits? That's why I say lose fast, win slow, because the slower or the longer you can stay in a stock that continues to go higher for you, the better. But if the stock's not going anywhere for you, or it just continues to lose for you, make that quick. Get out of it, man. You don't want any part of that. So Citigroup, this was a trade that didn't go anywhere for me. I got out of it, and since then it hasn't gone anywhere yet either. So that's where stop loss also helps you, is it keeps you from just staying in a stock longer than you should, because if it doesn't want to go anywhere, why are you holding on to it? So so this is my two trade setups here that I showed you today. Apple, I lost 7.78% on it. Citigroup, I lost 2.74%. There was different lessons to be taken from each of them, and I hope that you can apply them to your swing trading. Thank you. God bless. Thanks for watching. I hope you enjoyed the video. Please be sure to like and subscribe to my channel, as well as check out some of these other cool videos that I've done. And if you want to swing trade with me each and every day, you can do so by going to www.shareplanner.com/splash zone. Thanks and happy trading.